guest, Erik Hirsch, the CEO of Hamilton Lane. Erik, great to have you on this show here. Now, let's talk IPOs. Of course, we've got SpaceX. We're waiting for Anthropic and OpenAI. As a collective, they created trillions of dollars in value before public investors ever even had access to them. Two of them we still don't have access to in the public markets. As you look at that, has the center of value creation shifted, arguably permanently, from public markets to private markets?
Marley, great to be back, and wonderful question. And the short answer is absolutely yes. That what you're seeing is the ability for companies to stay private much, much longer, and the ability for them to raise enormous amounts of capital while private very much exists. And what that translates into is that when they get served up, if they get served up to the public market, a lot of that value creation has already taken place because they've been in existence for so long.
And so years ago, I mean, companies went public much earlier in the growth journey. Why has that changed, do you think? And what does it say about today's capital markets?
I think there's a couple of reasons. One, just the sheer magnitude of the private markets and the capital that's available to them is allowing them to do that. To your point, earlier on, you didn't really have a choice. Once you got to a certain size and you wanted to continue to have meaningful capital to finance your growth, you had no choice but to go public and access larger pools of capital that way. The second piece is, if we went back a couple of decades ago, being public carried with it an enormous amount of cachet. People wanted to be a public company. In today's world, that's just simply less true. You being backed by incredibly high-branded, well-known venture capital firms or other private equity firms carries as much, if not more, cachet in some cases than being a public company. So those are two big differences, and that's why I don't see this trend reversing. This is going to be the new reality. It's been this way for a number of years, and it's going to be this way into the future.
So if this is the new reality then, Erik, is IPO still the ultimate destination, or will an IPO just be looked at as another financing option among many?
I think it's a combination. I think it's a question of what is the result of that IPO. If the IPO simply results in not a great experience for the public market investors, but a wonderful experience for the private market investors, then I don't see that as a success story. What we're going to need to see a healthy and happy market environment is you're going to need to see both. You're going to need to see companies who ultimately go public and whose stock then trades very well into the future. And that will also create value for the public shareholders, and it will create enormous value for the private shareholders. If what we instead see is companies going public and then having a lousy public market experience, that's terrible for the public markets. That still is probably pretty good for the private markets, given their much, much lower cost basis based on when they went in. So I think what we're looking for in a healthy capital markets is both parties being able to win here.
So if companies are staying private for longer to grow in size, but also try to avoid what you just highlighted, one of the potential perils of the IPO is becoming public and then seeing the stock tank, which we've certainly seen before. Does that fundamentally change how investors should be thinking about portfolio construction?
I absolutely think so. I think today, for you as an investor to not have exposure to the private markets means a few things. One, you're missing out on an enormous part of the economy. So today in the U.S., about 4,000 public companies. As you all have talked about over and over again, we've never seen such concentration in a small number of companies that are, oh, by the way, all correlated to each other. So that's a new phenomenon. And so if you're not in the private markets, you're missing out on all of that basic manufacturing, retail, mom and pop businesses, huge drivers of our economy. So the number of public companies in the U.S. is, this many. The number of private companies in the U.S. is this many. And so a well-diversified portfolio should have exposure to both. The second part, though, is timing. Again, things like, use the current examples, Anthropic, OpenAI, SpaceX, et cetera, those have been in private market portfolios for years and years and years at this point at tiny valuations because they were at that point originally a concept. And so early stage venture capitalists came in and financed that. For most investors, they've completely missed this multi-year journey and value creation that those companies have been on. And so if you're just coming to the party now at the IPO, you're coming in at a breathtaking price. You're introducing a lot of volatility, whereas the private market investors have been steadily creating significant value and return for their shareholders and investors for the last several years.
And Eric, while I have you, I want to talk about something I don't even know that I've actually gotten a chance to talk about on air here in secondaries in the private markets. Traditionally, they're sort of thought of as, a seller looking for an exit strategy, perhaps. You say that narrative's actually outdated and that people who are building better books right now are smart buyers using secondaries. So walk me through that.
Well, in the public world, as your audience knows, people are buying and selling and rebalancing portfolios continually, and they're doing it, frankly, in real time. In the private markets, the only way you have today to really rebalance or to change exposure levels is to transact in the secondary market where you're selling your fund interest to another investor. So not doing that seems utterly foolish to me. People should be portfolio rebalancing. They should be altering exposures as the markets are evolving and changing, which they constantly are. So in the public market, we view that as totally normal and sophisticated. For some reason, in the private markets, the secondary industry has a bit of a stigma in some corners where it's like, well, there's something wrong with that. The answer is it's equities. You're rebalancing and you're trading and you're moving. And in the private markets, because there is a premium given that illiquid nature, secondary buyers can do quite well because it's a much more limited universe. Data is asymmetrical. Again, not a free flow of information. And you're providing liquidity in an inherently illiquid asset class. So all of that then does very well for secondary buyers if they're smart, if they have good deal flow, and if they know how to execute.
Eric, I could keep talking about this with you for the next half hour, but sadly, our show only has a couple minutes left in it. So you'll have to come back and join us again so we can continue this talk. But really appreciate you taking the time today.
Thanks, Marley.
Erik Hirsch, co-CEO of Hamilton Lane there.